Welcome back to Mastering MHA MBA. This is Chapter 13, Part 4 of 4. You can now compute every variance in the book. This final part is about something more valuable: what to actually do with them. Which variances deserve attention, when a favorable number is bad news, and how to use variances to drive learning instead of fear. This is where variance analysis becomes real management control. Start with the right mindset. A variance is a question, not a verdict. It tells you that actual differed from expected and roughly where, but it never tells you why on its own. An unfavorable efficiency variance might be a lazy crew, or it might be a bad batch of material, a broken machine, or an unrealistic standard. The number points you to the right corner of the business. The cause still has to be investigated. Managers who treat variances as automatic judgments make bad calls. The good ones treat each variance as the opening line of a conversation. You cannot and should not investigate every variance. Investigation costs time and money, so it has to pay for itself. The principle is management by exception. Focus attention on the variances that are large in size or that recur period after period, and let the small random ones go. Companies set thresholds, say, investigate anything over 5% of budget, or use control charts that flag a result only when it falls outside a normal range of fluctuation. The art is separating a meaningful signal from ordinary noise, so managers spend their scarce attention where it actually matters. We touched on this in part 2, and it deserves its own moment. Variances are interconnected because the decisions behind them are. Buying cheaper material earns a favorable price variance but can cause an unfavorable efficiency variance when it breaks more often. Pushing the line faster can improve labor efficiency while creating quality failures that surface later as warranty costs. So you must read variances as a system. A favorable number in one place may be the direct cause of an unfavorable number somewhere else. Judging any single variance in isolation is how managers get fooled. Following from that, here is a trap that catches even experienced managers. A favorable variance is not automatically good news. A favorable cost variance might mean the standard was set too loose to begin with. It might mean a manager skipped maintenance, deferred training, or cut corners to make the numbers look good this quarter, storing up problems for later. It might mean underinvesting in something the business needed. So never just celebrate a favorable variance. Always ask how it was achieved. Sometimes the favorable number is the warning sign, not the win. Cost variances are powerful but narrow. They measure dollars, not quality, speed, or customer satisfaction. A plant can hit every cost target while quality quietly collapses. So leading companies pair financial variances with non-financial measures, things like defect rates, on-time delivery, yield, and customer complaints. Together they give a fuller, more honest picture. This idea, balancing financial and non-financial performance measures, grows into a complete management framework in the next chapter. For now, just remember that the cost variance is one instrument on the dashboard, not the whole dashboard. Finally, the human side, which ties back to last chapter. How you use variances determines whether they help or hurt. If variances become a weapon, a way to assign blame and punish, people respond by gaming the system, padding standards, and hiding problems so their numbers look clean. If instead variances are used to ask what we can learn and how we improve, they become an engine of progress. Many firms reinforce this with continuous improvement standards that tighten over time. So the goal is always getting better, not just avoiding blame. Everything we just covered is timeless principle. What has changed dramatically is the speed and the tooling. Variance analysis has moved from a monthly report to a live dashboard. Two updates to close the chapter. First, technology. Modern enterprise systems now calculate variances continuously and display them on dashboards that let a manager drill from a top-level number down to the exact product, shift, or supplier driving it. Recent versions of major platforms added real-time cost variance analysis precisely so manufacturers could catch a cost spike and act on it within days, before it compounded across a whole quarter. This is management by exception, automated. The thresholds and control charts we discussed are now built into the software, flagging the exceptions for you so attention goes straight to what matters. Second, relevance. For years, some argued standard costing was a relic. The volatility of recent years proved the opposite. When prices and costs swing violently, you need a benchmark to measure against and a method to explain the gaps, which is exactly what standard costing and variance analysis provide. Companies increasingly track variances as formal key performance indicators, and one 2025 analysis found cost variances reaching nearly 10% of sales, large enough to materially misstate inventory value if ignored. The lesson: this century old tool is not fading. In a turbulent economy, it matters more. That completes chapter 13. You can take any gap between plan and actual and split it with a flexible budget into volume and performance. You can break the performance piece into price and efficiency for direct costs and for overhead, including that tricky production volume variance. You know to investigate by exception, to read variances as a connected system, and to treat a favorable number with healthy suspicion. Most of all, you know variances are for learning. That is the full discipline of management control through variance analysis. Zoom out across these three chapters, and you have the whole arc of planning and control. Capital budgeting handled the big multi year bets. The master budget translated strategy into a detailed plan for the year. And variance analysis gave you the steering wheel, the way to control performance as reality unfolds against that plan. Plan the bets, commit to the year, then steer with variances. That is management accounting doing its core job. We can now plan and control performance against a budget. But that raises a bigger question. Is the underlying strategy actually working? Measuring that takes more than cost variances. It takes a framework that views the business from several angles at once. The balanced scorecard. That is the heart of the next chapter, where we connect strategy to measurement. Thanks for watching, and I will see you in chapter 14.